3.16% to $3,376 million in the first quarter of 2024. According to the report, the increase is higher than what was experienced in the quarter before now. That's 1.132 million recorded in Q1 of 2023, indicating an increase of 198%. Now, if you look at this indicates an increase. Further details into this report shows that portfolio investment ranked top with $2.08 billion. That's about 1.48%. Yes, that's what we have here. And orders are $1.18 billion. That's 34.9%, followed by the FDIs, which accounts for $119.18 million. That's just 3.53%. To get to understand all of these figures being railed out, I'm being joined by a professor of capital markets finance. He's also the director, Institute of Capital Market Studies at Nasarawa State University, KEFI. He's also the president of the academics, that's the Association of Capital Market Academics of Nigeria. He wears many caps. Professor Uche Uwaleke. Prof, it's good to see you. Good afternoon and thank you for your time.
Thanks so much, Tolu. Good afternoon. It's always my pleasure to be on your program.
Thank you so much, Prof. Prof, the figure that we see here is $3.38 billion in Q1 2024. That is right. And we see the breakdown to these figures. But first, let me ask you, is this enough when it comes to inflow from abroad to fuel trade and investment, which is what this money should do? Did we get enough in this quarter? What is your first reaction to the overall figure before we now get to break it down and to some specifics?
Yes, Tolu, if you look at the data from the United Nations Conference on Trade and Development on UNCTAD, you would conclude that this figure pales in insignificance compared to what some other jurisdictions are getting. Indonesia, a country that population-wise is in the same, bracket with Nigeria, about 260 million people. Indonesia records an average of over $5 billion in foreign direct investment every quarter. So on an annual basis, Indonesia's foreign direct investments amounts to over $20 billion. The same with India. India gets over $40 billion in FDIs, and even South Africa. Okay, so when you compare what we are getting with these countries, of course, ours, we are still not there. And remember, I mentioned foreign direct investments when I was talking. I didn't talk about total investments. In our own case, we are talking about total investments, at just $3.4 billion, in the quarter. So if you take out foreign direct investment component of that, okay, that gives you, from what we saw, the National Bureau of Statistics report, just $119 million, in the quarter. So compare $119 million, we got to the over $5 billion in FDIs I just mentioned in the case of Indonesia. So it's quite small, although it represents, if you look at the total thing that came in quarter one, it represents an improvement, just as we read, over the previous quarter by as much as 210%. Total investments coming in at $3.4 billion. But again, as I said, that's all that is cheering about it, the fact that total investments improved. But if you disaggregate that, really, let me even say from the onset that the capital importation has three components. You have the foreign portfolio investments, you have the foreign direct investments, and then you have the other investments, notably loans. Okay, so in the first quarter of 2024, what did we see? We saw much of what came in, The $3.4 billion that came in, much of that, was foreign portfolio investment. To be sure, foreign portfolio investment is seen as fluctuating capital. It's also seen as, speculative, and sometimes can also be quite destabilizing, in the economy, especially when eventually they get to leave. So foreign portfolio investment is an investment that are temporary. Okay, so they are not meant to stay. That's why they are known as, transitory or ephemeral investment. So when people come into Nigeria and invest their money in, especially government securities, 90-day, 180-day, government securities, that is portfolio investment, and of course maybe a few of such in shares. So in 2024 first quarter, what we saw was that out of the 3.4 billion naira that came in, $2 billion of that was just into, government securities, investing in our treasury bills. And that has been made possible, by the, monetary policy stance of the central bank, high interest rate environment. So foreigners, of course, found that, attractive. So I'm saying, yes, we have seen increase in capital inflows, but again, the quality of those inflows, should concern us. The fact that much of that, has come in by way of, again, what is termed hot money, shouldn't be something we should write home about. I think going forward, more emphasis should be on sustainable capital, stable capital, and that's talking about foreign direct investments, okay, as opposed to foreign portfolio investment. So, as I said earlier on, about $2 billion came in as foreign portfolio investments, and then 1.2 billion, about that came in by way of loans. So the real capital that can create jobs in an economy, the foreign direct investments, as I said, came in at a very little amount. So going forward, that is something we should, seek to address.
Prof, it's very interesting to start our conversation this way, breaking it down. But for you, the issue of confidence comes in here. Many will say, are we getting that level of confidence expected, considering the reforms being undertaken by this administration, that the likes of World Bank and IMF has continued to say that is the way to go? So are we attracting the needed investment? Because for FDIs to still be this high, and you said there are not monies that we could really depend so much on, when are we going to get to start to improve FDIs, which seems to be more stable?
Yes, FDIs are a function of the business environment, ease of doing business, must be right. If you also notice, maybe I should also say this before I continue, if you also look at the sectors that even got these funds, again for me, that's also an issue. The fact that much of that came into the banking sector, about 61%, banking, and then trade got 15%. So the bulk again went into the services sector, all right, yes, with very little of it, just about 5.7% going into the productive, what you would call the productive sectors of the economy. Talking about manufacturing, agriculture. These are actually the areas we should be attracting investments. And of course, if they had come into manufacturing and agriculture, we would have seen an increased, proportion of foreign direct investments in the total capital importation recorded in Q1 of 2024. So essentially, for FDIs to improve significantly, we need to do a lot about the business environment. When we talk about business environment, it's a whole lot of things. The fact that businesses are complain today about multiple taxes. Of course, there is still the forex issue. Then multiple taxes, the state of infrastructure, particularly power, roads, and so on. So we need to deal with these challenges before we can expect meaningful improvements in foreign direct investment. But the good news, I think, is that, especially with respect to the fiscal policy side, the fiscal policy constraints to businesses, I think that is being addressed. To the best of my knowledge, the effort of the Presidential Committee on Fiscal Policy and Tax Reforms, I am optimistic will yield a lot of fruits, particularly when government begins to implement the report. And we are beginning to also see that even some of the issues addressed by that committee are even beginning to receive attention, by the government. We've seen in recent times government, giving some waivers of in terms of the withholding tax credit, for example, and issues around exempting small businesses from certain taxes. So I think the idea of at least getting that space right, the tax issues, having to streamline taxes, all these will help to improve the business environment going forward. But as I said, it's not going to be achieved overnight. I'm sure with time that aspect will be taken care of. But there are other things I also think that must be done to begin to attract FDIs. If you look at countries that are big in FDIs, again using the UNCTAD report, much of the FDIs that go into Indonesia come from Japan, China, the Netherlands, Singapore. So if we really need to change the narrative in terms of FDIs inflows, then we need to consciously, deliberately cut these countries. As I mentioned, Netherlands, Japan, China. So we have been dealing with China over the years. It's now to say, as opposed to bringing in your finished goods importing finished goods into the country, we'll now get them to come to Nigeria and set up their plants in Nigeria to produce those things here. Okay, that is one way you can ensure that there is a technology transfer. Okay, and also one way you can also ensure that more jobs are created within the domestic economy. So we need to attract them, to bring them to Nigeria to set up factories and then manufacture here, as opposed to importing finished goods from these countries. So that is the way to really go about it. And I also think our embassies in this country should receive more attention than maybe the others. Whether in terms of funding, we should fund them better to be able to create this awareness, about things going on in the country. Now, it's not all about insecurity. That there are also, despite the negative news they hear, that there are positives they can also leverage when they come to Nigeria, to invest.
Let's move quickly to look at the debt issue, which, of course, the DMO has come up with a report, and coming up with another report saying that Nigeria's debt to GDP ratio stands within the World Bank and IMF ceiling. And according to them, that stands at about 55%. Please, what is your understanding, Prof, of all of this?
Yes, well, if the DMO says it's within threshold, I agree. That's talking about debt to GDP ratio. International threshold is within about 56%. That's international debt to GDP ratio, 56%. Even though ours has crossed 50%, it's still within that 56%. I'm sure that's what the DMO was referring to. And in terms of debt to GDP, if you look at Nigeria and compare Nigeria with other countries of the world, you will also find that debt to GDP for Nigeria is relatively low when you compare Nigeria with even South Africa or most of the countries in the world. But for me, debt to GDP ratio is not the issue. Debt to GDP is just a metric, a number that you can decide today to change. So if tomorrow we decide to rebase our economy, I understand the process has even begun. We rebase our economy again, and then we get a bigger number in terms of GDP. It means the moment you increase your denominator, debt to GDP, once the denominator increases, of course the debt to GDP drops, and then would you clap and say you are doing well? So the issue is not about debt to GDP. It's more about our capacity to, to take loans. It's more about our capacity to service the loans we have taken. So that's why, for me, what's more important is the debt service to revenue ratio. Capacity to absorb debt, capacity to, in terms of debt sustainability, what should be prominent should be, out of the 1 naira you earn, how much do you spend servicing your debt? So that's, for me, more important, debt service to revenue. And if you check over the years, our debt service to revenue ratio has been one of the highest, okay? Even in sub-Saharan Africa. At some point, we had it over 80-something%, debt to GDP ratio, especially when the revenues of GOEs were not included. But even with the inclusion of the revenues from the government-owned enterprises, okay, you still have a debt to GDP ratio that is in excess of 60%. In some cases 69%. So that's very high. An interpretation of that is that for every $1 you earned, let us even talk in dollar terms, you earn $1, you spend as much as 70 cents, servicing debt. So that leaves you with very little to even meet up with your recurrent spending, not let alone capital. And that's why you find that, we have, if you check the data really, over the years, we have actually been borrowing to even finance recurrent expenditure. And that is why we are, we have come to the point where we are, where that it has not really not become a burden. So going forward, the emphasis should be on debt service to revenue. So when we want to talk in terms of debt sustainability, it's not about debt to GDP. It should be about debt service to revenue. Okay. So the solution is, of course, you would say, of course, expand your revenue. If you're able to grow your revenues, okay, of course, that reduces the problem, because debt service to revenue will drop. All right. But the challenge is we are unable to grow revenues, and then we're also taking on more debts. So that's worsening the situation. If you look at the structure of our debt, okay, we have done external debts. External debts now have come up to as high as maybe 43%. Domestic debt, about 57%. All right. Now, for external debt, my worry about external debt structure is the fact that it is again the commercial component of that, has grown over the years. Commercial, non-concessional. That is talking about the Euro bonds. You have Euro bonds that account for maybe about 35% of your external debt stock, but in terms of debt servicing, you are spending over 50% of your external debt service on the commercial component. All right. So that is why it's worrisome. On the domestic side, I've also said it, that there is nothing wrong in government borrowing. We need to borrow to finance our deficits. As a developing economy, we must run deficits. We must, of course, also borrow to finance that. But how do you, when you borrow, what do you do with the money that you have borrowed? I think that's what is key. So for domestic debt, if you look at the structure of the instruments we have used, okay, the FGN component of that is over 78%. So, and when you use FGN bonds as an instrument to borrow, it gives you a discretionary power to use the funds for anything you wish. So, unlike when you use infrastructure bonds, if you issue infrastructure bonds, it is tied to infrastructure, and then that is the only thing you can do. And that is why I think that part of the problem we have had is that we have used more of FGM bonds as opposed to infrastructure bonds. So going forward, if we want to borrow, let us use more of infrastructure bonds, like Sukuk. Sukuk is a good example of infrastructure bonds. The size of Sukuk we have in our domestic debt component is just less than 2%, 1.77%. So out of our total domestic debt stock today of about 62 trillion naira, just 1 trillion has been represents outstanding Sukuk. And yet, when you go around this country, you see Sukuk signposts, projects being undertaken just by $1 trillion. Imagine if you were to triple that, or if you were to have up to, say, 5 trillion naira worth of loans coming from Sukuk. That means the projects will be more. So the point I'm making is that the strategy, the approach to borrowing has to change. When we want to borrow, we have to make sure that loans are tied to infrastructure. Loans are tied to things that will eventually generate revenue. Because if you have good infrastructure today, if you have good roads, if you have the inflation rate will come down. The business environment will be such that businesses will come, and you can even raise revenues from the taxes that businesses will be paying, because they'll be profitable. Okay, so it's a win-win thing. It's something we should seriously consider. So we shouldn't just be borrowing for borrowing's sake or to finance recurrent expenditure. Borrowing must be tied to projects. Yes, and that's also the one way you can easily measure and monitor, account for those, as opposed to just using FGM bonds. So that's the point I want to make.
Professor of Finance and Capital Markets, Nasarawa State University, Kefi, Director also of the Institute of Capital Market Studies at the same university, Nasarawa State University, Kefi, Professor Uche Uwaleke. Thank you so much. It's always good having you on the program. Enjoy the rest of your day.